Okay.
Hi and welcome to FTSE Funds and Finance, the straight talking podcast brought to you by Goodwin Financial Services. We're at season 1, episode 3. I'm joined by Steve Goodwin and Josh Goodwin. Gentlemen, what a week it has been.
Yeah, it's been a bit hectic.
It's been traumatic for the markets. There's a lot to get through, so we're going to jump in. So we're going to talk about the mini budget first of all, Liz Truss and the Chancellor, what they've done. I'm going to cover parts of it, and I want you guys to tell us what you think. So I'll just give a rough breakdown of what's happened. So basic income tax has been cut from 20% to 19% from April 2003. They've abolished the additional tax rate of 45% for the high earners, so it's going to a single higher rate from April. They've reversed the NI raise, the national insurance raise. Cancellation of the corporation tax, which was going from 25, obviously now staying at 19. There's tighter rules around the universal credit and the job searching part. There's stamp duty, obviously no stamp duty on the first 250, obviously up to 425 for the first time buyers. Obviously we talked about it in the first episode, the energy cap, and obviously they now expect that to be 60 billion over 6 months. And also they've got rid of the banker bonus limits as well. So it's a big mini budget, the biggest mini budget we've ever seen. Steve, first of all, for the average Joe, what does this mean, this budget, and how does it impact?
Okay, so the way I look at it, inflation is the biggest danger to an economy. If you look, for example, in Turkey today, 80% inflation over there, 15% interest rates, they still can't control inflation. Inflation devalues your wealth and makes you poorer. So if you imagine, the best analogy I can give this is we're on a train, right? And at the end of this train track is a wall and a cliff. So if you bust through the wall's protecting you from the cliff. So as we're sitting here today, we're going down this train track, and we're going quite quick. So the Bank of England decide we've got to intervene here. We're going to put our foot on the brake in the train. So you've got the Bank of England sitting on the train driving it, and they're pushing the brake up. So by putting interest rates up and by trying to control the amount of money going into the economy, they're going to try and stop us hitting the wall and going over the cliff. So then Liz and Al Quasi come along and go on the other side. They've got dual controls, and they decide they're going to put their foot hard down on the accelerator. So we've got the bank sitting there today with their foot on the brake, and you've got these two putting their foot as hard on the accelerator as they can. Now that's a problem. And no matter what's happening here, what the bottom line of this budget is, we are borrowing money to fund the rich. Mm-hmm. Now, this, to a certain extent, when Thatcher took over in 79, that was something she did for the economy was ruined in the 70s, and it worked then. This is different. Mm-hmm. This is something where, in my opinion, I did not believe she was going to implement these policies.
We talked about in the first episode, we said this is her policy, we don't think she'd go through with it because it's crazy.
Because it's crazy. And it's still crazy, but obviously, you know, the IMF have come out.
Yeah.
Everything Sunak said would happen has happened. The pound has devalued, which means the cost of us buying goods now, especially energy and oil, go up.
Yeah.
Because we buy a lot of things in dollars.
Yeah.
And this is what happened to Turkey, why they get their currencies devalued over the last 3 years by 3 times. So it's like our pound going down to 30 cents against the dollar.
Can I just clarify that, Pip? So obviously as the pound drops, obviously against the dollar, as you say, so now we have less buying power for when we use the pound to use it, and that's why it affects us so badly, and why
inflation goes up even further.
Because obviously you need to...
And then nobody wants to buy our government debt because they think this is going towards junk debt. They don't want it. So the Bank of England yesterday are forced to buy the debt because nobody else wants to buy the debt to shore up the economy. So they're going back to quantitative easing again. So what's happening, you've got two factions totally at war. Mm-hmm. You've got the Bank of England, who are saying, you're nuts, and we're going to have to introduce radical policies. And you've got these people over here who've got this ideology that is basically contradicted by 99% of world economists and monetary people. Mm-hmm. So she's either a genius or a lunatic.
So, just to clarify a couple of points there. So, obviously, people may or may not know the Bank of England and the government are separate. They run independently. They're supposed to be aligned, and that's what we're seeing at the moment. Is part of the turmoil is that they're not aligned. They're not.
They should really, whilst they're independent, their foot should be on the brake at the same time and their foot on the accelerator at the same time. And in history, that's what happens. But here, this is the first time in a long time that you've got that. Hence why Truss is talking about trying to remove the independence of the Bank of England, because she wants to control that as well. I mean, this is just nuts.
And that was what was announced yesterday, wasn't it? The bond buyback, which is what the Bank of England buying the government debt, buy it back to try and shore up some of the shit. And it's been a turmoil week in terms of the markets, Josh, and as well as interest rates. Obviously, we took the Bank of England beginning part of this week was saying that might step in, might do an emergency interest rate rise. How has that affected the mortgages? I know there's been a lot of mortgage products that are thing, but how's that gone in?
The mortgage world's gone mental, as most people have heard already. It was the most products withdrawn in a day, more than what happened during the beginning of COVID. So you can see how much the reaction is from some of the lenders. Like you're hearing lenders pulling rates after offers, they're pulling rates pre-offers. So it's unknown territory for a lot of brokers. I can see a lot. I'm speaking to other brokers and they're all saying the same thing, like the world's gone crazy. Mortgages aren't great at the moment. I believe there are some lenders coming back with interest rates starting at 5% now, where if you think back to February they're about 1.5%.
Crazy.
That's a big jump in 7 months?
Yeah.
So it's a bit of a different time now, and I think the housing market might start suffering.
And when you say obviously products have been withdrawn, people may not know. Obviously, a lender might have a rate out yesterday that was 3.5% or 3%, and literally you cannot get that rate. They pull it straight away from the market.
It's like at Halifax, they pulled all their rates with a fee. No fee, with a fee attached.
Yeah.
They obviously didn't. They're worried about their margins going forward. I done a mortgage for a client of Halifax on the Friday, and on the Monday that rate was just pulled instantly, no warning, nothing. Usually you'll get half a day to a day from the lenders. But yeah, they're pulling them without notice. HSBC done it instantly, Accord done it within half a day. So lenders are just pulling rates left, right and centre.
And that's because they're unsure of what's going to happen, obviously this uncertainty.
They're obviously seeing that over a fixed period of 2 and 5 years, the way they set their rates, they can't be certain what it's going to be, so they're not comfortable lending at the moment.
And obviously part of the mini budget was the stamp duty obviously increase. Again, that's slightly counterintuitive to each other, right? You've got interest rates being raised by the bank to try and slow the market, and then you've obviously stamp duty effectively trying to kick the house.
To try and make any sense or logic of this of Quasi and Liz, it's not possible. It's trying to, and I'm not it's trying to make sense of the insane.
Sure.
And this really goes against all economic logic. And okay, you can have stamp duty. Great, we'll give you, save you $2,500 or on stamp duty or whatever it may be. But don't worry about that. But your payments are going to be £500-600 a month higher. But that's going to be a real incentive. It makes no sense.
Yeah.
Because that makes sense when you're trying to kickstart a market. We've got the market doesn't need kickstarting. It's at an all-time high. It's been the housing market's been running on cocaine.
Yeah.
But now it's like rather than wean people off the drug, with what she's doing at the Bank of England, they're threatening to do. It's like taking somebody and making them go cold turkey. I mean, there are real severe consequences going forward. So let me just summarise this in 3 ways, right? We've explained the thing about the accelerator and going over the cliff. She has 3 choices. 3 choices. Number 1, she does a U-turn.
Mm-hmm.
That doesn't look likely. Number 2, she puts massive public cuts on public spending. Now we're looking at police force that's short, the NHS. Again, part of it is to do with cuts, but part of it is organisation. And we're talking about things like the legal system's in a mess. Now, if you cut public spending at a time like this, not only do you cause more chaos, you're cutting jobs.
Sure.
So you're therefore affecting again the growth of the economy. So that's option 2. Option 3 is to do nothing.
Mm-hmm.
And if she does nothing, there is a high risk of housing repossessions and a housing price crash. Now,
and that because a result of interest rates going up.
because the Bank of England are going to battle against, and the Bank of England are going to go, if you do, the Bank of England have said, we think we could put the bank rates up to 6%. Now, that is a shot across the bow. That's saying to these two, look, if you carry on like you're going to carry on, this is what we're going to do.
Can we put that into monetary terms, Steve? In terms of when you say 6%, people hear 6%, 2%, 1%. How much is that going to... It's difficult to say, obviously, aside the mortgage, but what we're talking about, if interest rates go up 6%, how much, ballpark figures, people's mortgages
So
going
if
to
you
increase
take,
by?
for example, 6% being the base rate, you can have mortgages easily of 8. Mm-hmm. So I'll give you a simple thing. For somebody on an interest-only mortgage of, say, £300,000, mm-hmm. they would have been paying about £370 a month. Mm-hmm. If you take the 300,000 8%, you're talking £2,000 a month.
Jesus.
Just for the interest portion of the loan.
Yeah.
Now,
see, that I think resonates more with people than 6%, 8% in terms of putting it into
now you tell me how many people out there are going to survive. Not only if they do try and survive, their spending will go to zilch. Sure. The economy will stagnate.
Especially on top of the energy rise, because obviously I know there's a cap, it's been inflation's been running as it is.
I class myself fairly intelligent in economics. She was educated at economics, I think, at Oxford. But I think she skipped some lessons. Mm-hmm. Because this makes no logical sense in this current climate when you've got an inflation issue. However, I think she'll go for option 2. Mm-hmm. I think she'll cut public spending dramatically. And that's going to be what she does to try and say, hold on a minute, we're not going to borrow all this money. But then there's going to be a devastating effect differently. If she cuts public spending dramatically, the economy will go into a halt, interest rates will be more under control, inflation will come under control by default because people don't have it, but because there's less spending going on. But whatever one of the 3 options she chooses, apart from a U-turn, even a U-turn's bad for her because she probably gets booted out. Whatever she does is a bad situation. There is no simple situation for this, unless if she stays as she is, then she would have to defy all common logical economics, and that's why I said, on that basis, she may prove to be a genius, mm-hmm. although I doubt it.
It could go through. And if mortgage rates were to go up to 6-8%, as we talked about, that's something we haven't seen for a long time, Josh, in terms of...
not in my lifetime. The man opposite me has seen it.
I've seen 15.
Yeah, I mean, that's a huge...
And the 15% was at the end of the Thatcher era.
Sure. Yeah.
Because Thatcher done wonders, but she put everything on heroin, and it went out of control. Her policies went out of control, and we ended up with 15% inflation and house price falls of around 60 to 70%.
Yeah.
So I've lived there. I've lived in it.
So if we talk about the mortgage rates as well, and we talk about obviously variable rates and tracker rates and how that is going to affect that. So how would that affect you? With variable rates and tracker rates.
So people on tracker rates, lifetime trackers, have benefited for 20 years with phenomenal deals.
For those that don't know, can you just briefly explain what a tracker is?
So going back in 2003, 4, 5, you could link your mortgage to a tracker rate, and I remember I linked my mortgage to a rate that was 0.2% below 0.49% below the Bank of England base rate.
Sure.
So I was basically paying no interest.
So if it was 2%, you were paying 0.49% lower than that.
Yeah. So over the years, people on trackers that have got rates at minus 0.49 plus 1.2 have been paying insignificant interest rates where fixed rates have been much higher. Mm-hmm. What's basically happened in the last year or two, fixed rates have dropped so low they've sort of been in line with the tracker rates. Mm-hmm. The problem that we have, and clients have asked me this, what do I do with my tracker rate? The problem is nobody knows, because you are dealing with crazy people. Mm-hmm. You're not dealing with logic anymore. So do they go to a fix? The problem is, as they do more what's appeared to be crazy stuff, the fixes rise further. Sure. And this has all happened instantaneously. Mm-hmm. So if you go and fix in at 4.5%, 5% for 5 years or something, and then you give up your tracker rate, which is currently sitting at 3, you're going to give... What happens if this does come under control, that they get booted out, that Labour get in, that there's an election, that the Tories overthrow them, they change their policy, you may be stuck potentially in a rate that's looking really stupid.
Sure.
But on the other hand, if they don't do a U-turn and they keep pushing up, you could be better doing that. The problem that you have as a financial advisor is that you can't predict in this instance what's coming next. We normally try to predict and give guidance. The problem with today is we don't know what they're going to do next. And we've never in history had an experience where we've got a government that is doing everything against economic fundamentals and a Bank of England that is threatening to wield them with a stick. So I wouldn't want to give advice to people. If the advice I can give people is, if you are that scared, then go and fix it.
Sure.
If you are not scared,
if you want a security, go and get the fixed rate.
Then go get the fixed rate. But you may end up biting you in the backside because we don't know. But if you want the security, get the fixed. But nobody can tell you has got a crystal ball to say what is going to be better. And anybody that does try and say that are lying. We don't know. So you've got to do what makes you feel comfortable. If you are scared, fix. If you are not scared and feel comfortable holding, hold.
But obviously, go and see advice. Obviously, that's not advice in terms of that. But
it's not advice. It's just a general. I'm not giving advice because I don't know. So I'm just saying. But fixed rates are there for people that are scared.
And that's why you go and get the advice that you want to do it. So, what's the best thing that people can do in the short term to try and protect themselves the best they can while all of this is going on with the markets doing what they are, the interest rates being talked? What is the best thing the average Joe can do at this way, or is it just a wait and see situation?
Generally, I think the best thing people can do is stash, make sure they've got a money in a savings account that they can fall back on. That I definitely feel that people should, even if you've got a mortgage now that's on a fixed rate, and you know that in 2 years, 3 years it's coming off that fixed rate, I believe you should in effect think about, well, I can afford £400 more and save that £400 to act as a cushion for you should the worst come to the worst. So I think cash reserves or investment reserves are absolutely crucial. Don't live the high life and spend everything you have and wait for because if this comes and goes wrong, you may end up finding you in trouble.
Okay. So that's basically most of what we can cover this week in terms of the budget. Again, just to recap, obviously the best thing to do is build the reserves and it'll be interesting to see what happens.
Do you think, Josh, that lenders will be more restrictive on who they lend to?
Yeah, definitely. We've already started to see that in the last month or two. Go back again to February time, you'd get pretty much a minimum of 4.5 times someone's joint income for their mortgages. We're already seeing that being dropped to 3.5 to 4 for some lenders. That's only going to get worse with higher interest rates. The stress test is going to get tougher. And I think the amount of money people were able to borrow the last 5-6 years is going to be a lot less. So yeah, it's going to be tough out there.
And that ultimately will then affect the housing market. If people can't get the mortgages that they're required, they can't pay the prices.
I think the housing market's definitely in trouble unless something happens. Logic tells me once the fixed rates start ending, people's fixed rates start ending in 2023, 2024, they come to remortgage or product transfer, and they're seeing their repayments go up by astronomical amounts. They probably a lot of them might be forced into selling. But the problem is, if these people are on 5% or 10% loan to values, there's a chance they could be negative equity by then. So I think we could be in a very dangerous position in the next year to 18 months.
And what would your advice be for people who've got fixed terms that are coming up to expire end of this year, beginning of next year, middle of that? Is it
end of this year, beginning of next year? You can start to try and protect yourself if you want to. If you want to, you can use up to 6 months before. Start to look at different rates about, and you're in a better position now if you're doing it expire in the next 6 months. You can protect yourself to some degree. You're going to see some short-term pain with interest rates going up from when you fixed before, but you won't be seeing the crazy figures that could be coming next year
if we end up to that point. So that's an important distinction to make. That if people fix term, don't realise they can start looking 6 months before their terms end. So if your mortgage is up within the next sort of 6 months, get advice now is the key, and the advice from the gentleman here to protect yourself the best you can. Gents, all right, well, thank you very much. We'll call it a day for today, and we'll see next week of what the Bank of England have done.